TGIF Warriors. How's everyone doing? Hi, Brock, Kevin, Forex Gal. Yes. Hi, Alexandra. And yes, Ben Maldonado will be with us at the top of the hour. How you doing, Didier? Okay, so on Fridays I'd like to take a look at the weeklies, okay, and see what's happened on a weekly basis. So, I've been talking about higher yields, and that's definitely manifesting. This is your 20-year ETF TLT. Pretty negative week. I mean, they've backed up, yields have backed up pretty good on the long end in the last 3 weeks. This was your sell signal on a 2-week reversal, and we're getting follow through. 2-week reversal still intact, probably headed down towards this level. And I actually think that we're going to take out this low for some type of, maybe this was A and this is A, B, C, and now we're going to get for B, and then we get C down here. But definitely yields on the rise and not just on the real long end. Here's your 10-year. They're a little soft today. Yen's getting clobbered. Not sure what's behind that, but here's your weekly on the 10-year. And we talked about it coming out of the hole a couple weeks ago. Then we had, kind of a quiet week. So everyone thought, yeah, and then you also had the Fed who thought yields would go up after the Fed. And look at the confluence up here around 120 with the 50-week moving average and just a little speed line I drew in here. This is where I think we're going. And what's interesting, not not that I'm taking a lot of victory laps on this, but I brought this up yesterday, why gold might head lower, and that it's all about yields. And Steve made the point that yields could go up if you're patient. I think one of my partners will cover that, Biswatjit. Um, maybe pay attention to what I'm talking about now, and it'll help you with the yen, Kiwi yen. So Steve was saying that yields could go up, and you could still have gold going up because we're behind the curve. And so you have to, today's a perfect example of it. Gold and silver coming back, and the dollar getting killed despite yields going up. So, it only took 24. Yeah, it only Reno or me. Yeah. So it only took 24 hours for what Steve had to say. And I pay attention to what all my team members say. I mean, you guys have no idea how much I've learned being here at Forex Analytics in the last 3.5 years. How it's taken me to a different level because I pay attention to my teammates whose work I respect greatly and learn every day. So, if I can learn after, I don't know, 30, 40, 50, 100 years, new stuff, so can you. Okay. So, these face webinars, I think, are priceless, free, but priceless. So, I just want to cover before I turn it over to Blake. We had this kind of action across the board on the Fed. And so you could kind of get an idea of, what's really leading the way here. See how we had spikes? This spike, I think it happened on the Fed, and it happened in a blink of an eye and came off. So look at this. Euro has taken that spike out, right? Many markets have taken it. Aussie did. Look, Aussie's really been the star of the show, and chart of the day pointed out that Aussie looked good yesterday. The charts of the day also they're free, and you get great trading ideas from that. I really am also proud of how we give to the trading community. At our expense, we give, and that's for your benefit. So at our expense, we give it away. A lot of people just won't give anything away till you pay them something. Okay, so retail positioning in currency is probably not as important as other markets. I had a very good guest, Charles, the other day, and I was talking about sentiment, which is kind of similar. And he pointed out sentiment isn't as effective. Okay, so sentiment is not as effective as what you have in other markets just because of how deep they are. Okay, so I wanted to point out, with everything taking out these spikes, there's a couple things before I do that. Crude oil, boy, we're getting a lot of stuff here. Yeah, so we never got a third drive in the crude, and it's still an up week. So if we hold 42.40, I still think there might be a shot to sell it next week. And look at how, risk on, like I was talking about this yesterday when we were here, with all the exuberance that we've had with risk on and a weak dollar. Crude has really been a very poor performer. It's just been comatose for 4 weeks. I want to be short crude. I actually think that crude, once we finally get a top in here, is going to head back down towards 32, maybe this 28 level where we broke out. I think there's a big short coming here. And, instead of trying to top pick, which I have a hard time not doing, S&Ps, why not sell the weak sister? But getting back to those spikes that we had after the Fed yesterday, look, gold has not taken out its spike. Silver, I believe, has. No. So the metals, although they're up today, are showing less relative strength than the currencies and other markets that just took out the spikes that we had yesterday. So it's very possible that when the stock market peaks, we might get a lower high in the gold, maybe sometime next week, to complete some type of ABC. So I'm on the lookout for possible short in the gold, because it's, even though it's had a decent week, let's see, looks like an inside week, and the chart of the day nailed it holding that low. So the analysis has been this low right here, and Blake came in yesterday and said we had to hold the low. We did, but I'm just saying what I'm seeing is, compared to the currencies, the gold and silver have not taken out those spikes. I think they will, but just the fact that they're lagging rather than leading, there might be something to do counter trend next week. So I want to thank everyone for being here with us. And if we helped you this week, best way to say thank you is to become a subscriber here, right? So, at least, try Forex Lite. So there are, lots of options for you guys, right? For you to, become a member. And if you think you're being helped in face, just imagine if you had all of this at your fingertips. So we have a lot of different plans for you to consider. The monthly, semi-annual breaks down to 10 pips a month. The annual's 9 pips a month. And then, of course, we have Forex Lite. And we've demonstrated all week how news flow, what we have with Data Flash, is almost as good as what you pay a few grand a month for on Bloomberg. So that comes with your membership, and that's just a tool. That's nothing to do with the interpretation and research that this team provides every day, 24/6. Anyone, we have any new members to welcome on this Friday? Or who's going to sign up today? I'm not bashful. Are you? So there's several hundred of you in here. I know there's a few people that haven't yet. You're new, Reg? Okay. All right. Well, thank you. Appreciate you coming on board. And with that being said, everyone consider it. The weekends are a good time to get familiar. You're new? Okay. You're very welcome. And I'm going to turn it over to Blake now. How are you today, buddy? If Blake is here today, I know he's here.
Hey, Dale, can you hear me?
Yeah, I can hear you. Sounds like you're a little in an echo. Well, I mean, you're not echoing, but it sounds different today.
Or does it sound better or worse?
Clearer. It sounds fine. Just like a little, like a little bit of a hollower sound, but it sounds fine, loud and clear.
How about this? A little different. I don't know. The reason why I'm asking is because I did get a new microphone. I don't know what all the buttons do, so I'm not 100% sure what I'm doing with it.
Okay.
So
that sounds like me. I'm sorry I rubbed off on you.
Yeah, no,
Mr. No Tech, Low Tech.
Yeah, it's a microphone. I've never actually owned a real microphone. Something that's not a
headset.
Not a headset, right? So, and it's a nice one that should have very good sound quality, but I just need to make sure that it's.
Yeah, I like the sound. How about you guys? What do you think?
Too much on the bass side. I think it needs a little bit of an adjustment, but good microphones, you can adjust them.
Yeah. Thanks, Steve. I don't, like I said, I don't know what all the buttons do yet, and I can just start flicking around things, and who knows what happens when I do that. So I've got to kind of figure it out.
You need a touch more treble. It sounds a little bassy.
Well, that's just my voice.
Okay. All right.
That's just his voice in the morning.
Get that frog out of your throat. All right.
So, well, you talked about the yen, Dale. Abe is resigning because due to health issues. So that's what's actually doing that to the yen. Big, huge reversal overnight. Must have been right after I went to bed. I mean, literally, because I'll talk about this one here in a minute. If you look at the dollar yen, I mean, this is just like, we were just cruising higher, and then all of a sudden, we just fell so aggressively. And so, it's been amazing, but that's really put a lot of pressure on just the dollar in general. And so when you look at like today's moves and you go, well, why didn't we move like this yesterday? I mean, yesterday we spiked up, we came down, and then we just kind of held. And it's hard to, I mean, I know the dollar was already starting to weaken going into, this news about Abe, but I mean, stocks are higher marginally, but the dollar is just really getting crushed across the board. And, is it lack of liquidity? Are we just, going into this, into today, basically, knowing that, hey, the dollar is going to be weak, stocks are going to be strong, and we're going to get a resumption of trend. It's going to be, something to watch, especially when you're talking about the euro, and the euro is approaching really key. This is key resistance. You can see this is if we're going to develop a head and shoulder pattern, we're going to stop around here. These are going to be the levels that we're going to find some pretty key resistance, I would assume. But like I said, the dollar is just under significant pressure today. You can see the dollar index is just, excuse me. Sorry about that, guys. Hold on. The dollar index is testing that, really key trend line. Once again, this is the multi-year trend line. And, I think we're at risk of breaking, and especially with, the added pressure of not just, this is, again, you think about, is this, just a dollar move because of the Fed? Is this a move because of what, Jerome Powell said yesterday in his comments yesterday, is that what really is doing it? You know, you combine that with a weaker dollar yen today, which, I mean, look at the dollar yen, it's down 130 pips today. You know, you add those two together and you do have a situation where the dollar could get significantly weaker. Okay. So, and you know, so anyway, we're going to go through these charts and let's get the analysis done. Stelios is not here today, but we do have data coming out, right? Steve, we do, right? Let's see. So
we have,
I
mate,
think,
yes.
yeah, we have durable goods orders. So I guess first and foremost, resistance is right here, 119.20, but you know, because that's going to be all of these highs right through here. But this inflation data may move the market, and that's, you know, obviously the Fed is super hyper focused on inflation. So you know, knowing that this PCE data is probably going to be a bit of a mover, and the personal income and spending. So you know, the market's going to be a little bit more sensitive to that today than it has been. So 119.20 is resistance, and then right after that 119.20, and after that, excuse me one second, guys, just making some adjustments here. I have this with the microphone in my face, it's a little bit harder for me to see everything, especially when you're I'm a pecker typer, not a typer, so I have to sometimes look at the keys that I'm dealing with. So 119.60 would be key resistance.
Let's see the microphone. Is it one of those old style ones that
it is
the radio guys use and everything?
Yeah,
nice
it kind of looks like that. Yeah, it was my birthday present from my wife.
I love those.
Yeah, she's like, you need to upgrade your equipment, and I'm like, you know, because to me, I'm like, well, the headset worked just fine. You know, it doesn't bother me. She's like, no, you need to upgrade your equipment. So happy birthday. I'm like,
you could be a DJ with that, buddy.
Yeah, I guess. So 1850, if you guys don't recall, that was really big resistance on the way up. So that's going to be big support on the way down, or at least support. I can write it as that. Okay, let's go over to the cable. So the cable's at new all-time highs, or I take that back, new trend highs. I was talking to the traders in the chat room, and you know, you look at what the cable has done the month of August and try to be directional. I mean, just good luck. I mean, it is really, really challenging trying to find decent trends in the cable. I mean, you're buying it one day and you're like, oh, it's breaking out, and then it just slams down in your face. You're like, oh, I'm going to get short because it's breaking down. And then it's right back up in your face again. This is a very challenging market to be directional, and especially with the cable. I mean, the cable is just, I mean, it's breaking higher now, and it's above, you know, it's above this monthly or weekly 618, and it looks like it's breaking out. A lot of resistance coming up, trend lines coming into play, but I mean, as of right now, finding like intraday resistance, I'm gonna have to do this, you know, last known high to this last low right there, 127% extension, 133.30, and then 134.08. So I'll write them down. They're not great resistance. 40, 134, basically. I have to go with, we're bullish, right? I mean, the dollar just looks weak, like I said, pretty much across the board. So support on dip should be down at 132.50, because remember, that was big on the way up. Okay. Aussie dollar, it's bullish. It's breaking higher. 161% extension of this last move lower comes in at 73.64. So it's bullish, right? Support will be 72.80 now. And you want to be a buyer dips on this one. Whoops, I didn't mean to do that. 0.7280. Let's go over to the Kiwi. Well, we ended up holding. Oh, we are breaking out right now, by the way. We held that 65 cent level. Obviously, looking back in retrospect, that was the ultimate place you wanted to be long. I mean, it never gave it up. That was a multi-year trend line. It sure did trade heavy for the longest time, but obviously it's loosened up here. So, well, we got to look at support. Would be probably right there, which will be 66.90. And then resistance will be 67.75. Okay. Dollar Canadian. This one's just, broken down, all sorts of support. Now these are really key supports. If you look back on the daily charts, this is where you get a full-on reversal of the dollar Canadian. I mean, it could really implode here because you got this breakout and then reversal below all the support. So, key support is 130.50. We have to put that in bearish because we are now below a lot of support. So 131.30 is now resistance. That was a resistance. So because that was support. Remember, it's multi-year trend line support. So, and that's what was holding us right through here, through here, through here, through here. And since we sold off overnight, now any rally back towards there is going to find some sellers, right? 131.30. Okay. Dollar Swiss. So we finally broke out of the triangle yesterday. Or we tried to break. We got held back in, and then today we broke down. So 90, I'm just going to write 90 even. I know it's 90.10, but should do this. Key support. Remember, we've stayed bearish since we've been below the 90.50. So now below 91.20. Okay. So that's bearish while below 91.20. And then dollar yen. Where's the dollar yen? Dollar yen is obviously this is broken. So dollar yen is really important because for a couple of reasons. Obviously, with Abe, stepping down, that may open the door for the dollar yen to trade back towards 100, if not below. Remember, and this is kind of like the point that I was making the other day. Prime Minister Abe steps in with his 3-arrow approach to the economy. We go from 80. This is a weekly chart, by the way. We go from 80 something to 125, right? And we've backed off. Now his policies that he's been in the leadership position for almost 8 years. His policies, they're not going to be unwound, but some portions of them will be. And so that's why, because of him, stepping down, the yen could probably strengthen. Then on top of that, you have a weak dollar as it is. So for those reasons, the dollar yen should be weak from here on
Blake,
out. Yes.
On what you mentioned about Abe, one extra reason, in my opinion, is if I remember right, Japan pre-Abe had a decent amount of political instability. I mean, for a period of time, they didn't have prime ministers that could actually survive more than a couple of years. So it's also that with Abe, that situation changed, and from a period of political instability, they went in a period of stability. So perhaps the market is also worried that they can go back to that period. You know what I mean?
Yeah, that's
Which is
that's,
never
that's
good for an
valid
economy.
point. Valid point. I'm just writing down some support levels here, just because obviously, we're buckling under some pressure here. So let's go from this low to high. And great point, Steve, by the way. 618, 786 would be 104.77. Okay. So I'm keeping it in range because we had this false breakout. We're still really, there's always been buyers down below 104.50. I just don't know if they're going to be there as aggressively now because of, situation has obviously changed. So just think about that. Here's the dollar index. So dollar index, obvious support is going to be 92.10. This is multi-year support. So this is a multi-year trend line. So it's really, really, it's really key. Oops, I pressed the wrong thing here. Okay. Resistance will be now any move back up to 92.50 or 92.60. Okay, and we have to, flip it to bearish. I know we've been bearish, but we have to make sure we keep it on bearish while we're below this 94 level. I'd have to have a pretty clear indication that things are reversing now. Dollar Mexican peso. This one's been probably one of the most frustrating for me because I made really good money in it yesterday, being long, and it's given back a lot of the. I mean, I took some profits off the table, but I mean, it's given back all these gains, and it's, like trying to hold on to a position that look when you have this is the daily. Look at the daily candle. That was an outside day, big white candle, just huge, right? And then this happens. It's hard to, get directional when this stuff happens. It just, been grinding lower all night. So support here is 21. Remember, 21.85, 84 has been major support down here. We're there again. We're here right now. So I'm going to write down 21.80. Okay. And that's key support, resistance. And we're still in a range to remember that they buy it. I mean, it gets bought down here. So, but 22, I think we wrote down yesterday 22.20, but I'm just going to write down 22.30 is just resistance, and that's it. Probably be best just to leave that one alone for a while until, with stocks higher, it's going to keep some downside pressure on emerging market currencies. That's the bottom line. US dollar, Norwegian krona, we're trying to build a base. Now we just hit new lows, but we're testing this trend line. Once again, this is the big broken trend line. But next support below here is going to be 871. And resistance now is, probably right there at 885. So 885, 871. Bearish. Gold, once again, gold held. Oh shoot, we got data coming, don't we, Steve? Shoot. I'll go gold and S&P here in just a second.
Yes, mate. We do have in 30 seconds now.
Whoops. I need to open the data flash here. And let me move that over here. Okay. There you go.
We have Canadian GDP included in the data, so that might move the CAD if it's outside the expected by a lot, because to be honest, when the expected is almost minus 40.
Right.
percent. I mean, I don't know what's a big miss.
Yeah, who knows?
Under normal circumstances,
All right.
0.2.
The data is coming out. Canadian GDP, a little bit better than expected. Right. Yeah. GDP annualized is a little bit better than expected. Still, obviously, pretty nasty data
It
there.
beat Bloomberg.
Yeah, it did. Okay. Here comes the all the inflation data. PCE came in a little worse than expected. It's not really moving the market. You can see the PCE came a little weak. Personal income stronger. Personal consumption probably due to stimulus. It's nothing too revealing here. And frankly, it's just not really moving the market all that much. See if the Canadian's getting a little lift off the lows, but I mean, the Canadian's trading really heavy here. Euro dollar is coming off just a little bit. We are making a slightly lower high, so just be careful with that. Dollar yen's getting a little bit of a bounce off of these lows. So it looks like the dollar's firming just a hair. Not a lot, but it is. Okay, let's go over to the chart that I feel was so important yesterday.
Gold.
Yep. Gold held you can see that spike down yesterday. This is at the 1900 level. Then we spiked down again right into support when we held. So you have to respect that. And so with that being said, with all the support holding, that means this trend line is going to be very important. So right now it comes in roughly around 1910, 1915, I'm going to write down 1915 right now. Whoops. It's important. And resistance, once again, I mean, we did spike up all the way to 1977, so I'll just write 1975.
The question is, are we breaking out? Just drag the resistance trend line you had initially put there as a general concept. Oh, this might be a triangle.
Oh, you
that
mean
one? Yeah.
Yeah, I mean, hey, we could be at least trying,
Yeah.
So I wouldn't want to stand in the way of gold right now.
Me neither. That.
Yeah. So I mean, that's definitely a way to look at it. Okay, let's go over to the S&P, and then I'm going to let you take over. So where is my S&P? Well, so let's I guess we should point this out. This is that big. Let's see. We are really close. We're at 3,500, obviously. 3,550 is the big resistance. So for right now, resistance will be 35. What is that? 35.12. Okay. 512, and then 35.50 is major resistance, and we're bullish. And you have to stay bullish while you're above. Well, this is probably right there. Would be yesterday's lows, right? 34. What is that? Well, that's 34.60. Then we have, 34.50. Yeah. So I would just say, while we're above 34.50, no reason to be bearish whatsoever. All right. So Steve, analysis is done. Your bias chart is ready for those of you that use it. And I want to say TGIF, everybody. It's been a hell of a week for sure.
Oh, it's been for sure.
I mean, I like have a hard time wrapping my head around a lot of the things that have happened this week. It's like, oh my God. But anyway, I want to thank you all for being here with us. And I know we've dealt with some Zoom issues this week. I know some of you had some problems logging in this morning. I would expect that Zoom, you know, they've got growing pains as a company. You know, they have so many people that are working online and doing things, and and using their services, that it's the growing pains of any company is going to be dealing with. So just bear with them, bear with us. That's obviously the service we use, and we chose them before the pandemic. So, but because of the pandemic, it's created a lot of reasons to use this. So anyway, I just wanted to make mention of that.
To all the companies in the industry, I mean, they all had to, in zero time, adapt, to accommodate seriously more volume. I mean, nobody could have expected that. Right.
Exactly. So, Steve, I'm going to pass it over to you. And thank you, Dale. Thank you, Steve. I know Stelios is listening in the background, but he's away from the microphone today. So everybody have a great weekend, and thanks very much.
Thank you, Blake. Dale, are you with us today? I'm assuming he's not as we speak. Okay, so Blake, as always, did a wonderful job covering the majors mostly in FX. So no reason to really go through them again. But what we said yesterday applies to them. I mean, for example, the cable is still very well bid, now passing through the confluence of the 61.8 and horizontal support resistance area. In my opinion, that's quite an important move. While the Euro USD hasn't broken through the range yet, that doesn't mean it won't happen. It's likely it's going to happen. And the reason I'm saying this is because, as always, I'm going to start from the DXY, and the DXY is at the precipice of breaking down here. We said multiple times this week, at least that I'm here, because previous week I was not on the webinars, that any type of rebound on behalf of the DXY would have to penetrate through the 94 resistance, because unless that happened, there was actually no real technical reason for somebody to want to turn bullish. So as it seems, despite yesterday's reversal effort, at some point the DXY was looking like it would reverse from the initial reaction, which was lower. We closed the day leaving behind the pin bar, which is most of the times, not always, but most of the times, an indecision candle. And today we seem to be about to succumb to yesterday's initial reaction from the market to Powell's announcements, which is to sell the dollar. And it really looks really heavy, and it really feels like there is a very big chance that we need to see at least one more push to the downside before we can discuss the possibility of a rebound.
What a range-bound August, huh, bro? Look at that whole month of August between 92 and 94, basically.
Yeah, but you know how it is, Dale. I mean, after strong moves, when the only thing a market manages to do is just consolidate, that's not a good signal if you're looking. That's not a good signal if you're looking in the opposite direction, right?
Right.
That's why we say very frequently that trend is your friend. I mean, many people have been caught trying to buy the dollar just because they saw a single candlestick, they saw a 2-hour reaction that told them, oh yeah, okay, finally, I mean, it's overdone, it should reverse higher. Yeah, I mean, something being overdone is just a reason not to try to jump on that trend, since it's very mature, because the risk reward might not be accommodative anymore. That does not mean that you should fade it. Go ahead, Dave.
You also you have nice divergence developing on the daily, but what made me cautious is some of the lower time frames when we got that look like false breakdown in the dollar. The RSI was in the 20s before that bounce. You know,
it
there-
was an RSI you seen in
Yeah.
bearish moves. Yeah.
yeah,
No, I agree with you. I agree with
Yeah.
you, and I really don't see why somebody would want to fight dollar weakness. You know, very frequently, it's in our psychology. Very frequently, we can't help ourselves but fight moves that make no logical sense because we cannot just hit the circuit breaker that connects logic and emotion to what is a wise trading decision. But in this case specifically, for the dollar to be in the defensive under current circumstances, it is the logical move in any case, right?
Yep.
So in this case, wanting to be long dollars is not only fighting the trend, so technicals, but in essence it's also fighting fundamental forces.
it's also
Um,
the only tool, one of the best tools that the Fed has, even though they're not going to say, we don't want a weaker dollar, but if they want higher inflation, which was Paul's statement, no better way than to debase your currency, and then you have inflation at least in nominal terms, right?
Of course,
Because you
of course,
can buy less with your currency,
and they're going to find out that this is a very slippery slope. Because eventually, and I've said that if you remember years ago, eventually the only thing the Fed is actually going to succeed in doing is waking up the inflation monster, in essence, taking the genie out of the bottle. And once that happens, which is mostly going to come initially through the dollar's debasement, there is no easy way of putting that back in, as people found out in the 70s, for example.
I remember.
So I know you do. So I'm a good.
You know what it took to put the genie back in?
Yeah,
Paul Volcker and 20%.
Paul Volcker and 20% short-term rates.
Yeah.
That's what it took.
Yeah.
And you know something? Many people don't realize this. The economy managed to withstand back then this type of a medicine. Why? Because it was in a much healthier state.
Yeah.
Because not only because it had a lot less debt, not only because people had a lot more savings, but also because the average maturity of the US debt was much, much longer, which means that the rather short-lived spike in yields to 20% actually didn't have the time to affect that much the servicing cost of the debt, because the maturities of the debt back then were rather long. Now,
and I think long rates went to about 14%.
Yeah, of course. I mean,
Yeah.
long rates never made it to 20%. Yes,
Right.
that's true. I don't remember the exact level, but what you're saying sounds more or less
Yeah.
reasonable to me. Probably it was something like that.
Yeah.
So major differences between then and today. Some of the promises that candidate Trump had made and he didn't fulfill. Not that it's an exception, right?
Surprise.
I mean, this is the definition of any politician, right?
Yeah.
If you
promise
remember,
everything.
he had said two things: that he wants to decrease the debt, and that he wants to extend maturities. He did, more than anybody else, the exact opposite on both counts. To be fair, the same applied to the president before him and to
Yeah.
the president before him. I mean, Bush made the debt explode more than it had ever done in the past. For Obama to succeed him and make the exact same thing, and Trump is doing the exact same thing. The question is, because it's not a matter of who, the question is, okay, is this trajectory in any way sustainable? I don't know what the argument is. I mean, I really don't know how anybody can make the argument that it is. It's a matter of when, not a matter of if. I mean, just if you see the plot of like the debt, deficit, and everything else, it's it's just out of this world. I mean, it's unbelievable, and I don't know. I'm afraid the end game is going to be very, very ugly. Anyhow, dollar is definitely in the defensive at the moment. We are very likely to break down here. Is gold breaking higher already? Yeah, I mean, it might. Let's see how we close on the day. So far today, we have an inside white candle. Let's see the significance. I mean, we can be more certain about the significance of this trend line support. Why? Because it passes through many more points on the chart. The significance of this trend line resistance is not that certain. I guess we'll have to find out. I'm also looking at this horizontal support resistance area roughly at 1980. So, I don't find any reason why somebody would want to, like be all in gold, given the fact that we've been consolidating for some time, and, a correction is always a correction, and you can't be sure in advance what type of form it's going to take as long as we're below 1980. But I can tell you that above 1980, the chances that we've already seen the corrective move unfold and we might be on our way to new highs increases substantially. So I can tell you that much. Silver toying around with an equivalent trend line resistance. We're a little bit above it here. So I'm monitoring that as well. But as I said, the chances that they're both going to be claiming new highs have substantially increased since yesterday. Let's see how we close the week, and we take it from there. Now, yesterday at some point, the dollar really made a serious effort in reversing higher. The fun part was that I wrote at some point that the dollar is attempting to reverse, and if that's the case, you should watch equities, because we know that as a fact. There's no question about it. Equity traders are always the last to get the message, always. So at some point, they started getting a little bit worried. We saw indices being negative, but dollar didn't manage to hold at the highs, which I'm pretty sure that if dollar closed at the highs of the day, the market would open a lot more defensively today, having to do with stocks. But what I can tell you as a fact is that the VIX, and let's have a look at it here, the VIX actually posted yesterday quite an interesting candlestick. It ended up being a large spinning top, which is like an indecision candle. But I mean, yesterday was the second consecutive day that the market, the VIX actually didn't buy the market's froth. So the VIX rallied both the day before yesterday and yesterday, and it was up even when the market was at the highs of the day in both cases. So I think you should really, really start being careful up here. We are over this ascending wedge at the moment. We've stalled in the Nasdaq. That was the S&P before. We've stalled in the Nasdaq at this ascending channel trend line resistance, also like a 227% extension of this last corrective move. So I have to say that from a risk reward perspective, I mean, yeah, I know everything is like bid, and it's like a one-way train, and it doesn't seem to stop for anything. But both of the major indices are on resistance at the moment. I can't really not make that comment. At the same time, that the dollar is just holding, clinging on the last area of support here. Now, as I said before, and I don't take that back, the dollar does look heavy, and the dollar does look like it might break down and produce another leg lower. And probably, if that's the case, we might see the stock market like rallying for a few more days. I mean, it's it's not unlikely at all. I mean, the whole thing of what has happened since we bottomed out, is like a very unlikely development. I mean, yes, we got all that stimulus, no question about it. But to be fair, I never imagined that the market can completely ignore the fundamental reality just because of all the stimulus. I thought that all the stimulus would make the hit a lot smoother, would make the reaction a lot more gentle for market participants, would induce a nice rally, a corrective rebound rally, and that's why I initially bought like 24 something, and I rode it to a 28.50. But to be honest, I never imagined that would be enough to completely bypass and ignore anything that has to do with the real economy. But it is what it is, and you know, these are the markets we have to trade, and you know, these are the markets we're trading. So it's, you know, getting angry or whatever with it doesn't help you make any better decisions. Quite the opposite, actually. Dale, are you still here, by the way? Okay, he's off.
Yes, yes,
okay.
yes.
Do me a favor. I need to take it for like a few seconds. I need to change the battery to my headset because it's just beeping in my ear. Okay, just give me a few seconds.
Leave your screen on.
Yeah, absolutely.
Okay. Any questions for me, guys? You have 120 seconds. You want to know if I'm doing anything special this weekend? Which is the most ridiculous question you could ask anybody. Looks bad, man. Sansi. It's going to 87.40, I think. Sell every pop. Virtual karaoke? Haven't done that yet, Brock. There are people doing that.
I was fast, wasn't I?
Yeah, you were just in time to for me not to do virtual karaoke as Brock requested.
You should actually show them the pictures with you karaokeing. I don't know. Do you have a video as well, by the way? You've never shown.
Yeah, Kentucky Rain. Yeah.
Yeah.
Anyway, yeah, go ahead, bro.
Okay, so EG. Somebody's asking about EG, so I can mention it because I mentioned it yesterday as well. Listen,
what's your
EG,
target down there? About 87.40? What do you
in
have?
EG?
Yeah.
First important support resistance area is at 88.50.
Okay.
Below that, we have 87.70. That's the confluence of the 78.6% fib and the 200 daily moving average.
That's about what I'm looking for, 87.40-ish or so.
But
I think Greg had the possibility of like 84 or 85 a few weeks ago.
Admittedly, it does look heavy. By the way, since we have quite the movement today from USD yen, I thought that it's a good idea if we cover a few of the yen pairs, which are not part of Blake's T-chart analysis. I have to say that I have to say that many of them are displaying some nice attempts of a reversal. In particularly, I'm looking at Euro Yen because Euro Yen, let me draw it here so you can clearly see it. Euro Yen might be attempting, might be attempting here to put on a double top. Of course.
Would they take the high out by about 5 pips?
Of course.
The previous high.
Yeah, most probably they did. In order for this to be a double top.
That's why we teach people not to put their stop right over
the
swing high. You have to give it tolerance or the algos are going to eat your stops up. You know what? That'd be a good Twitter handle for me. Forex Stop Hunter.
Yeah, if only you had thought of it a little bit earlier, right?
Yeah, I think so. This Pinker guy has it. Well, I have to take him out.
We have. So one decent candidate for a reversal here is Euro Yen. Now, don't jump the gun here because today's daily candle looks, very nice, very promising, but we're still holding within this ascending channel. And most importantly, we're still above this horizontal support resistance area at 124.30. But I'm
put it on the watch list.
Yeah, but I'm pretty sure you should put it in the watch list because a breakthrough 124.35 is probably going to produce further losses and probably accelerate the downside. So this is one to watch in the days ahead. Now, if you have a look at the pound yen broke through what was a triangle and the consolidation. Today was the second consecutive day that we were pushing through, and look at this reversal, and we're now back testing the triangle. So also at quite a key juncture here. I mean, if we break through within the territory of this broken triangle, that's probably not good news here. Also keep in mind, I showed this a few days ago, and I said that, even if we break through that, keep in mind that we have this larger channel, and we're getting rather close for comfort to the channel's trend line resistance.
Why can't this
So
whole thing be a big ABC? All the way back from March.
this one, it's a more complex correction. Might be a zigzag or so. It's
Okay,
more complex
yeah.
than an ABC.
All right.
Double zigzag or whatever.
It looks like it to my uneducated Elliot.
So, be a little bit careful with this, because this is also a decent candidate for a reversal. Now, let me be honest, between euro yen and pound yen, especially given the fact that euro pound looks rather heavy,
Right.
I think euro yen is probably a better choice
Yeah,
to go with.
that would be
if
my
you-
preferred.
Yes, if you want to play the reversal, I think the euro yen looks more attractive. Now, let's have a look at some of the commodity currencies against the yen. Here's the Aussie yen. Finally broke through yesterday this corrective triangle. So far as we speak, today's nice bullish candle has now transformed in a gravestone doji. Not that much of a good signal. Although you do need to respect that as long as we trade above 76.80, which was the breakout area, it's probably not a good idea to try to fade it. Okay, Kiwi yen trapped in this rectangle. So far I'm not saying something really bearish here, but keep in mind, there's also this longer term trend line resistance. The closer we are to it, the worse the risk reward in being long. Of course, if we break through it, then I think it's a totally different ball game. I do think that we're going to see some follow through. And here's CAD yen to cover some of the majors against the yen. Yeah, there it is. So here's CAD yen. So CAD yen broke through this rectangle. I mean, we had been talking about it, that eventually we're going to see a breakout and a follow through, and it did break out and it did produce follow through. And out of curiosity, let's see, was that follow through enough to actually fulfill? Yeah, it actually did fulfill the target of the rectangle. So today at the highs we did fulfill this rectangle's target, and we seem to be producing a nice outside black candle as we speak. So also something to keep an eye on. Let's see how we close the day in all these pairs, because some of them start looking rather attractive, especially for people that want to catch reversals. Thanks, Blake and Steve. How's your view in Nasdaq QQQ? It hasn't really broke yesterday. No, it didn't actually. It didn't. And as I said, pay a little bit attention though, because we are testing a confluence of resistances in the Nasdaq, as I showed earlier. These ascending channels, resistance, and some fib extension. So pay a little bit attention to this area. Although this has been a crazy run. One of the better years we've had in the Nasdaq, in a year that we've had one of the biggest black swans. But whatever, it is what it is. Maybe a silly question, but what are your thoughts if Fed increased interest rates to discourage USD shorting? The market is going to get disintegrated if the Fed does that. If they attempt to raise rates, risk assets are going to get disintegrated, literally disintegrated. I mean,
maybe the Fed doesn't have to. Maybe the bond vigilantes, which were at work over the last couple of weeks. Take a look at the TLT.
Yeah,
20-year.
but something. These are nominal rates.
Right.
And the
Okay.
Fed remains the main player in these markets. So unfortunately, I'm not that optimistic
I think they're
about.
sacrificing the bond market to accomplish whatever they want. I think they've already, when they came into
First of all,
corporate and junk bonds.
they own the bond market more or less nowadays.
Yeah.
If we're talking about treasuries, right?
Yeah, we are.
And for every month that passes, even more than the previous one. So
Well, they, whatever they owned is worth a lot less in the last few weeks. That's all I can say.
yeah,
Right.
but the problem is that they have an infinite
Yeah. They
ability
don't have margin calls.
to be underwater. Yes,
Yeah,
yes,
no
that's the
forced
problem.
liquidations by the Fed.
Nope,
Yeah.
nope, absolutely not.
A crashing dollar is their margin call.
Yes, absolutely. That's actually the only, and that's why they're trying to prepare the ground for inflation. So when it comes, they can claim that
Victory.
everything is okay. That's what we wanted.
Right, I agree with that. I think it's time. It's actually time for Ben Maldonado.
Yeah, it is actually. It is. I mean, it's 4:01. So if your guest is here,
he is.
Okay, perfect.
Mr. Cycles. Well, thanks for all your hard work again this week, Steve. And some nice looks today with pointing out what's happening with some of these crosses. And Ben, I'm going to get you all set up here. Really looking forward to what your work is.
Somebody's asking about cryptocurrencies.
You want to go ahead, give a quick look on Bitcoin if you want.
Yeah, Bitcoin has turned lower and, might be breaking some type of information here, but I would still be rather careful because as long as we trade above this broken trend line resistance, the trend is higher. So keep that in mind. We're looking like we might pull back further, but I think that as long as we trade above like 9,000 and change, the path of least resistance is higher. Thanks, Dale.
You're welcome, Steve. Have a nice
Everybody
weekend,
have a nice
partner.
weekend. Yes, you too.
Okay. Okay, Ben, I'm asking you to unmute.
Hey, Dale.
Hey, Ben, my trading warrior brother.
How you doing, pal?
Good. Great to hear your voice again, Ben. A lot of stuff has happened since you and I talked. I don't know, how long ago was it?
We talked probably around 3 months ago. I think it
Feels
was
like 3 years.
Yeah, I think it was in early May.
Yeah. Okay, so do you recall how to screen share?
Yeah, let me share the screen here.
Everyone stick around for Ben. Take a look at some of his market geometry and cycle work. Okay, so go ahead, take it away.
Yeah, today what we're going to do is we're going to take a journey to the 70s and back. And Dale, we're not even going to need to use any psychotropic drugs to do it. So.
It's going to drop.
Even though it's Friday, we're gonna stay sober.
We're probably going to need some psychotropic drugs to go through the experience, though.
There's no doubt about that. If this stuff comes to pass, it's going to be quite the ride. Quite the ride.
A bad trip. Yeah, one of those.
Well, it doesn't have to. I guess it doesn't have to be a bad trip if we're prepared and if we,
we
put ourselves in a position to not be hurt and to probably benefit from it. I think it can be okay. So that's
build machine gun turrets outside your house.
Yeah, boy, that's crazy.
Anyway. All right, so go ahead. Take me back to the 70s. I'm ready. I'm flashing back.
With Dale for the last year and a half, we've been following this 70s analog about. Which is based on some of the work I've done showing how the present day circumstances we're going through are connected cyclically to what the planet and humanity experienced in the 1970s. And we'll go through and we'll show, and I keep adding to it. I keep adding sort of, as events unfold, I keep adding more similarities that I notice based on events that are occurring now with events that happened in the past. In January, when Dale and I got together, we were discussing sort of the outlook, as one does in January, about what to look for and what to expect in 2020. And the three main themes that I hit on were volatility And I put a check mark on volatility because we've certainly had that, not recently, but obviously at the beginning of the year, we had tremendous volatility. Inflation.
VIX is sure trying to come out of the hole here. Had a pretty good day until the fade yesterday.
Yeah, no question about it. And that's one of the charts I'll review later on is the VIX, and it's sending a message that we got to listen to. So volatility is a check as far as I'm concerned. Inflation, stagflation. Haven't seen it yet, but we're going to go through and look at the economic numbers and look at the situation and why it's a pretty high probability event that we're going to get this combination of stagnant growth and rapid price appreciation in the economy. And then the thing that I've been beating the drum on is commodities. And I'm going to show you a series of charts across various commodities that all have a very similar shape and similar pattern, which points to potentially explosive moves in the next 6 to 18 months.
Yeah, the grains have a heartbeat in the last few weeks.
Absolutely. I'm in the
I
grains.
noticed.
Yep,
Yeah.
I'm in the grains. I like them. I think we're at the beginning of a move out of multi-year, meaning 5 to 10 year bases, where the ballistics calculations just show really explosive moves and much higher targets, and we'll talk about that. So back to the 70s. Here we go. What happened in the 70s is happening again now. And the thing that people have to understand about cycles is we all want order. The human brain wants order, and it wants to make sense of everything. The cycles repeat, but they don't repeat exactly. They rhyme. We get the same types of actions and reactions. Events don't always unfold exactly the same, but there's a certain rhythm and a certain rhyme to it, to where you can get a decent idea of what's going to happen in the future based on the cycles that's happened in the past. And right now, the connections between the 70s and the present day are numerous and growing. The ones with the check marks are the ones we've discussed on previous speeches. A lot of it is the comparisons between Nixon and Trump in terms of our leadership in the White House and how they interacted with different constituencies and policies they had and what they're doing. The most telling one that can show you that it's just not chance or it's just not curve fitting that's going on here is we've had 4 presidents impeached in over 250 years of being a country. Two of them are connected with this cycle. So Nixon got impeached and Trump got impeached. There's only 2 other presidents who've been impeached. And I think that's a really strong piece of evidence. The ones without the check marks at the bottom are recent ones that I've sort of gone back and looked and said, okay, do these make sense? Are they connections? Is it fitting the scenario that we're talking about? In the 1970s, oil prices quadrupled. The Arab embargo, the OPEC embargo caused major problems and major stagflation, and we'll get into that later. But I was like, well, we haven't seen oil prices quadruple here, but what remarkable event did we see in oil prices?
Went negative.
That's right. We saw the.
You know what I'm noticing,
negative.
and I'm going to let you go, but that a lot of the events are the polar opposite of what happened. Like, let's say Nixon China was the opening and the beginning of the relationship, and Trump China is the end of the relationship. Oil quadrupled, and this time it went negative. And when you look at the 70s, and as bad as it felt, we were going into a major bottom and cycle into the early 80s. 1982 was a low in the market.
Mm-hmm.
And so we're getting the opposite now in a few of these things, which could mean that we're entering the end of prosperity. Before we were going a bad time into a good time, and now we're kind of going from a good time into what might be worse times. What do you think?
I think that is a fantastic observation. And it's coming from a guy who clearly understands cycles. They're not always exactly the same, but you can see sometimes it's a polar opposite connection.
Yeah.
And that's what we are seeing with certain events. And
Okay.
your analysis is spot on. You're a cycle guy at heart. That's what it tells me.
Yeah, 50 years.
One of the other interesting ones that has come up recently was the Cold War. Right? We were in a Cold War with Russia, had nukes pointed at each other. As a young kid in elementary school, I remember the ridiculous drills of getting under your desk in case the Russians launched bombs at us, launched nuclear bombs. But there's no question right now we're in a Cold War with China. When you have the countries closing each other's embassies and kicking out diplomats, that is emblematic of being at war but not shooting bullets, and that is the situation with China, and we hope it doesn't end up escalating into a hot war. But we know, I think right now we know we are in a Cold War. The one I'm on the lookout for is the last one here. Stagflation was a part of the 70s. It was high inflation, sluggish, low or negative growth. We are looking at a setup which will review the pieces that are in place for a similar type of occurrence, where we are most likely going to have sluggish growth and we're going to have high inflation. So we're going to see how it plays out, and we're going to see the evidence, and we're going to look for signs that it's coming to pass or signs that it's not coming to pass. And with any of these things that I'm looking at and the things that I'm saying, it's all about probabilities, right? There are no certainties in the markets. There are no certainties in the future. All we can do is look at the evidence, look at the cycles, and say what's probable to happen, what's likely to happen, and then you position yourself that way. You manage your risk, and as events either confirm or deny it, you make adjustments. You don't doggedly hold to your position and say, I'm going to be right, I'm going to be right. It's not about getting being right. It's about getting it right.
If you don't learn how to change your mind, you won't have any change left. W.D. Gann.
No question about it. So the headline on this slide is, anybody who has ever worked with analogs understands this. Analogs work until they don't. And so I took a twist on a very famous saying and basically added it to this, which is, all good analogs must come to an end. At some point, they stop following. This is the S&P from 72 to 75. The last time we were together with Dale, I'll show you the chart of the prospective path we were looking for. The X here shows where we stopped following. We were making a high. I fully expected a rebound. I played the rebound, same as Steve described, into the 2850, 2950 area. Got short through options, looking for the next leg down. We didn't get it. The analog stopped following. The main reason we did not get it is because of the intervention of the Fed and the government response. And I do have to say, the policy response was probably almost perfect. The way they handed out money, the way they gave out money, the liquidity they provided, the policies that they implemented solved the short-term problem. And it basically had the effect of pushing the cycles out. You can't eliminate the cycles, because remember, the cycles are things that affect human perception and human behavior, and that can't be changed. We react and we do things based on hardwiring of millions of years of evolution.
How much time do you think they bought us? 2-3 years?
I'm not sure yet. I put in here the arrow just to show where we are in time cycle wise. So we're, by no means are we out of the woods, and I'm going to show you what the cycles are calling for projection wise, and then we have to look and see, get confirmation from price before we dive in and take action. But the elimination of those benefits and the failure to produce this next stimulus, I think, is going to create and push us into the next phase of this cycle, which is, they solved the short-term liquidity issues, but they didn't solve the solvency issues, and that's the big thing, is that there's an amount of debt in the economy that can't be serviced with a reduced level of economic activity. And
Great
what
point.
they did by shutting down the economy is they've killed 40 to 50% of small businesses. And so in the aggregate, if you look at it on a whole, we're going to be growing at a much slower pace, and the economy is going to be smaller simply because it's going to take time to replace that supply and replace those that amount of GDP that's been lost. And so that we're going to go into it, but that's sort of the part of the stagflation. That's the stagnant, right? That's the stag, is that we're not going to be growing as rapidly. So here's the this was what we were looking for the last time. You can see the S&P was making a lower high. We had poked through the megaphone, and we thought, maybe we're going to see, this sort of pattern play out per the analog. Well, obviously that didn't happen. Here's what happened. We were at this point. We had a sharp pullback. It looked like we were at this point. We had this sharp pullback, and it looked like the analog was gonna follow through, and we were going to head on down. And instead, we reversed sharply. We made new highs. I'm thinking we're going to make much higher highs than we are right now. There are some, and I'll go through these in the next few slides. I'll show you some of the targets that we can look for. But once this blow off is done, and we'll show you not only price targets but timing targets, this is the pattern we're still looking for. This is the pattern that the cycle is calling for. This would be a pattern associated with stagflation if we get that. So we got to keep our eyes out for evidence that inflation is kicking up and the economy is not kicking up to the level it previously was. We'll do a little lesson in geometry and a little lesson in cycles here, and we'll walk through sort of some potential timing for this top and this blow off top that we're looking at. What you're seeing here is a calendar day. This isn't ES. Sorry, this is S&P. So that's mislabeled. Yeah. This is a calendar day S&P chart. What we've got here, these yellow lines are measuring solar degrees. So here we did one. We said, what if we go from top to top, high to high, 180 degrees? The high would have been last week. Well, clearly we exceeded that, so that's not gonna mark the end of this run. But we said, what if we go low to high, and we go to the March low, 180 degrees, takes us out to September 26th. So the wide end of the range of where we think how long this blow off could last is approximately another month. I mean, we could grind up or shoot up like a rocket. For all of September and the last couple trading days left in August. Another number that we're looking at is simply 180 calendar days. 180 calendar days takes us to September 19th. And interestingly enough, I said, what if we did 180 calendar days and 180 up in price? That gives us a beautiful 180 by 180 cycle, which would take us to 2617. Do I think that's probable? I think it's
36.
I'm sorry, 3617. I think that's I think that's very possible. And if you look at it, it's only what 125, 130 handles. I mean, it's not an unrealistic number. So keep an eye out for that timing and that price level, and that's something else.
Nice chart, man.
Earlier than that, this is a proprietary cycle that I have. And its timing is the 5th of September. So with these three, you can see we have a window in here where we're coming up on a time where we have good probabilities in our favor that we may put in a top. And so how do you handle this? Do you sell it as soon as it gets there into that window? Do you just take a dive in? What I like to do is I look to see what's the price action going into it. What's the price action coming out of it? Do you see a perceptible change? Is the reaction to news changed? Is the reaction to events changed? Has the tone of events changed? And as you observe and see those things and you watch price, you can get an idea as to the effects of the cycle. But at least the listeners and everybody watching this can know that starting in early September and going through the month of September, you want to watch for signs of change. Do we stop busting through resistance with ease? Does support stop holding? Does support start failing? Do we start getting stuck under old support? Those are the sort of signposts that you look for to be able to get a good gauge on what's going on in the change.
What a great chart, Ben.
Thanks. I
Everyone
like
take a screenshot and have it on your workstation throughout September. That's my suggestion.
So here's another one that we look at to get an idea on pricing. Where could we possibly top out? What are some levels to watch out for and take note of? This is on the ES basis. The numbers here, some of you will recognize some of them. There's a few Fibonacci numbers in here. There's Lucas numbers. There's golden rectangle, golden triangle type ratios that I've put in here. Again, it's just another way of getting an idea of where are decent levels where I really want to pay attention and watch price action and see if we get some sort of difference, some sort of change, some sort of turn, especially if it's within that cycle window from the 5th of September to the 26th of September. The one up at 36.28 is interesting. We've already hit the one here at roughly 3,500. So I've seen some people, Nargis, who does really good work, posted some stuff about hitting the top of her megaphone. So we're there price wise. We're not quite there time wise yet. So keep watch both sides of the street before you cross. Look both ways. Look behind you, because things could start changing and start happening at these different levels. Here's another look at geometry that can give you an idea of some levels where you might want to consider that we've topped out, or take some off the table if you're long, or potentially initiate short positions. On the ES weekly here, 35.18 is a level, which is this red bar here. We can also get up into the 3600s, and if things get crazy, even 3700 if it really gets going. So the idea is to watch these various levels, see how price reacts, and then that gives you information as to what potentially could be coming next. I heard you talking about the VIX earlier this morning.
Yeah.
I've got this chart in here because there's an interesting divergence that's happening right now. S&P made a new all-time high, and the VIX is not anywhere near the lows where we were in February and January when we were making.
And also, Ben, there was a huge gap on the way up in February, and it be filled at 18. And even with all these new all-time highs, it didn't even eat into the gap.
No. The VIX is telling you that there are participants in the market that are interested in protection, and
they're buying fire insurance now, aren't they?
That's exactly right. And you need it before the fire starts. So
yeah.
Pay attention to that. It's telling you that there are issues. People that are smart people think there's issues with the market and this level, and that the VIX is signaling something loud and clear. Inflation and stagflation. Let's talk about this, because this is part of the thesis that much like the 70s, we're going to see inflation and sluggish growth, or that dreaded combination of stagflation. The first thing we have to do is we have to talk about what actually causes inflation. There are two different sides of inflation. One is that there's excess aggregate demand. What does that mean? That's a fancy economics term, but it means the economy is either growing too fast, or there's too much demand, too much money chasing too few goods, right? That's where we have things are running hot, basically. The second one is where there's cost push factor, where you have supply side issues. So if there's the price of oil rises dramatically, oil is a component in many, many products in the economy. Because the prices of oil goes up, The prices of those goods that oil includes get raised by the suppliers simply because they want to recover their costs and potentially, hopefully, be able to maintain their margins. I have this little bullet in here about the grocery store. Anybody that's been to the grocery store in the last 5-6 months, doesn't matter what the Fed says, it doesn't matter what CPI or PPI or any of these other numbers they give us, go to the grocery store, you'll see inflation. There's incredible price increases, which is one of the reasons why we're interested in grains and the commodities. Commodities are beginning, the prices of commodities are beginning to leak their way down to the consumer. And the grocery store is a perfect example. I'll give you another great example, and it's a stagflation example. I went and got a haircut for the first time last week since January, right? Because the woman who cuts my hair opened up her shop again and started taking people. So I was talking to her, how's business? What's going on? When did you start up? We started, modestly in April, but we really didn't start cutting much hair until like in the last month. And I said, oh yeah. I said, how's business? What's it like? She says, 50% of my customers haven't come back. And so I was like, wow, so your business is cut in half. And she said, yeah, pretty much. I said, do you think they'll ever come back? She goes, some of them, no, maybe I'll get some of them. And so we then chit-chatted about just other stuff. And at the end of the haircut, I go to pay for it. And she rings it up. And I look at the price and I hand her the money. And I was like, I started doing the math. She raised prices by 15%. And
You were lucky.
Yeah. So
My guy doubled it.
Yeah. So, but here's a perfect example of the stagflation, right?
Right.
Prices up dramatically, but her business is down 50%.
Oh, Forex Gal is saying you should get a hair whiz or a Flowbee to cut your own hair. Right? Is that what you're saying, Forex Gal? All right. You come over and give me a haircut.
I got one of those problems where when I look in the mirror, I get all screwed up because it's the inverse, so I don't even want to try that.
Yeah.
So now let's talk about stagflation. What causes it? Stagflation happens when a central bank expands the money supply at the same time as the government constrains supply with fiscally restrictive policies. And so let's talk about what that means. And through examples, you'll understand it. In 1970s, oil prices quadrupled. That's that supply side cost push inflation, right?
Yeah.
At the same time, Nixon froze wages and prices and instituted a 10% tariff on all imports. So he fiscally restricted the economy by those moves, while at the same time, what happened with oil prices caused massive inflation. The combination gave you stagflation. Now, are we seeing something similar today, or is it rhyming in some sort of way? Well, I think it is. Present day, the Fed has printed $3 trillion. Any way you look at it, it's inflationary, right? It's more money chasing goods, chasing assets, chasing investments with the same amount of supply. That's inflationary. At the same time, Trump shut down the economy due to COVID-19, and we're not coming back to where we were for a long time. So we've got supply restrictions going on at the same time as inflationary conditions exist. That is a recipe for stagflation. Now let's look at the numbers, the economic numbers, to see if they support it. This is the Fed's balance sheet. Shows the massive increase in the flattening out. This is the inflationary part right here. This is inflationary. Next, M2 money stock. Inflationary.
Yeah.
Velocity of money. This chart amazes me. The velocity of money is currently lower than it has been any time, dramatically lower than it has been.
Even with all this printing, isn't that deflationary?
This is what the way I look at it. It's not deflationary, but what it is this is going to cause it's not going to have the bang for the buck that they think economically, because people aren't spending the money. The money's not circulating.
They're saving.
They're saving it. And what happens when you do that, you don't spend it, you're not going to get the economic growth that you expect. It's a stagflation recipe.
Okay.
Let's look at a couple
That's
more.
the stag part of it.
That's right. Here you got the unemployment rate. We've bounced off the lows because remember, this is the rate of unemployment. So the higher it is, the worse unemployment is. But we're still, if you look at it from a technical analysis standpoint, we're still higher than we were at the last recession, at the peak of the last recession.
We're testing it.
We're testing it. But this again means subdued growth. It's the stagnant part of stagflation.
Okay.
Job openings, similar story. We bounced back to the 2016, 2017 level. If this doesn't get back near up in here, our economic growth is going to be nowhere near where it was when this whole thing started. Personal consumption expenditures, nice bounce. Probably big part of that was due to the stimulus. But again, 2016, 2017 levels. It's going to be hard to grow like we were if these numbers don't improve. The last economics chart I'll show you is here's the CPI from 1970 to 1980. So for the decade of the 70s, more than doubled. Not saying that's what's going to happen again, just that I think given that Powell wants it, you got to look at what are the powers that be want and what do they not want and will not allow. They want inflation. They will not allow deflation. They're going to do everything in their power to ensure that we get inflation. And given that fact, we as investors and as traders need to position ourselves to benefit from that. So what are some stagflation strategies that you can employ? Some of these are ones that I learned from a mentor. I was just a young kid in the 70s, but I was very interested in investments and money and how the economy worked and all that. And this friend of my father's took me under his wing. He was a super successful guy. Lawyer, entrepreneur, banker, developer, did it all. And he had a playbook for the 70s. And part of that is this playbook. In a stagflation, what you want to do is borrow as much money as you can at the current low fixed rates. And why do you want to do that? And why is it sort of the opposite of what everybody except the really smart people and the really smart businesses are doing right now? Everybody's panicking. They're hoarding their cash. They're paying off debts. They're doing everything that a responsible person about money does. But if you really want to profit from a stagflation, if this is what's coming, this is how you profit from it. You borrow as much money as you can at current fixed rates because ultimately you're going to pay back principal and interest with dollars that are devalued, debased, and less valuable. And what are smart people doing now that we can see that we have evidence of? Despite the COVID-19 driven panic and recession that we've had, global bond issuance is at a record high, all-time high. Companies like Apple, who many people will argue, super smart company, most successful, most valuable company in the world, they've borrowed over $8 billion this year. And they have over almost $200 billion in cash. Why? You say, why would you do that? Why would you borrow money if you're sitting on $200 billion in cash? Because they're paying 2.6% to borrow for 40 years, and they understand what's coming. They know what's coming. They understand that money's going to be cheap, and the money they're borrowing at 2.6% fixed today, they're going to be paying back with a lot less valuable money in the future. So what do you do if you borrow money at current fixed rates? You buy real assets. What are real assets? They're physical assets. Gold, silver, commodities, real estate, land, equipment, buildings. Anything that's a physical asset is going, if we get this kind of inflation that the Fed is stoking and what the cycles are calling for, those things will all go up in value dramatically. The last quote you see here is from my mentor, and what he said. He's at this time in the 70s, he said, "What you owe in real estate today is what you'll be worth in the coming years." And that's because physical assets will appreciate and the dollars you borrowed will depreciate.
What a great presentation.
Thanks, Dale.
Is that the wrap?
Nah, not yet. I got a couple more to show you.
Okay.
So buying real assets. Here's what happened to real assets in the 70s. These are compounded annualized rates of return for different asset classes. Just take a look at them.
Yeah.
Look at the winners. Stocks and bonds did okay, right? They did all right, 6.1 and 6.6%. But look at the returns on the hard assets.
Yeah.
It's dramatic. Let's run through the charts real quick. Here's the Dixie on a monthly basis. All these are going to be monthlies because I want to look, when you're talking big picture and you're talking big cycles, you got to use the telescope, right? You got to see what the landscape looks like. Could they break this? Yeah. Could we get a really strong bounce in the dollar? Yep. I think that's more likely right now than a total collapse at this point. I do think at some point we're going to see the dollar get trashed, but a bounce not out of the question. Here's euro at a pretty important spot.
Yeah.
Major resistance right here. If we break through here, we got to run much, much higher. If we fail here, you're going to end up somewhere in here.
So let me ask you this. When it comes to trend lines, Ben, how many closes do you need above or below a trend line to make it viable? Just one or a couple?
One is good enough for me. Obviously, if you get a couple, you get stronger conviction and more confirmation.
Okay.
But I generally like to see one entire candle above or
Okay.
one entire bar above.
So the monthly close in a couple of days is going to be pretty important.
Pretty darn important.
Yeah.
Yep. Aussie. Same situation. Super important resistance right here at this 7280 area. We're above it right now. So
Yeah.
if we can get above and stay above, like the next month's candle can stay on top of this, that's pretty bullish. If it can't and it fails, we're heading back down again. Gold. Interesting chart on gold. I like using these circles when you get something that goes parabolic because it can help define, the arc can help define the slope of the move and keep you in the trade. We're starting to poke out here, and we're poking out at resistance. This dashed line, in addition to these solid red lines, can be support and resistance. So do I think gold goes much higher longer term? Absolutely. Is there some concern on the shorter term for gold? Yes. I would not be chasing gold here. There's really strong support at 1800. If we should see that again, it would be a very, very strong buy on a monthly basis. Here's silver. And I want you to look at the silver chart for an important comparison. This silver chart looks exactly like the next 6 or 7 commodity charts I'm going to show you. It's just further along in the move. We've had the breakout, and look at the dramatic breakout when you get out of these big bases.
Yeah.
There's a 6-year base, right? 6-year base in silver, and look at the move you get. And it's what I think.
The bigger the base, the bigger the launch into space.
That's exactly right. Simple ballistics.
Yeah.
Here's an interesting trade that I think is setting up and you were on this early, Dale. I have to give you credit. A few weeks ago, you were talking about higher rates, and it has manifested in a big way, and I think the charts are supporting it. So we had this dramatic move up in the 10-year bond, right, defined by the circle, and now we've gotten out of the circle. When you break out of the circle, you either got to launch, continue to launch, or you head down, and I think the 10-year is heading lower, based on the chart.
What yield? About 120 or?
I didn't do it on a yield basis. I did
Okay.
it on a 10-year price basis, more
Okay.
around like the 133, 133.26, 134
Okay.
area, right in
Okay.
here.
Thank you.
Uh,
I'll figure it out.
on the 30, same type of situation, right?
Yeah.
The 30's actually come off much longer. We had the
Yeah.
high up here on the arc, and now we're dead on support. So this
We're
is
steepening.
This is a critical spot for the 30-year. If we
Yeah.
lose this 176, 175 level,
Yeah.
the trapdoor to hell is open, man. Much higher rates on the long end. If we hold here, we could bounce.
Yeah.
So now let's look at the commodities and remember the silver chart. Remember the silver chart. Here's beans. Soybeans yesterday had a big, this is a monthly, but yesterday's price action broke us out of a 4-year downtrend.
Embryonic.
There's your 6-7 year base, and we're breaking out. I think it could do what silver did, but in its own way, with a big launch. Wheat
Protein gold.
looks the same, doesn't it?
Yeah.
6-7 year base, higher lows, right ready to break out of this 7-year downtrend.
Pharaoh's commodity broker is buying it. You know who that is, right?
No, who are they?
The Pharaoh of Egypt, his commodity broker is Joseph.
yeah, that's right. They had a
Oh,
little
yeah.
wheat. They had-
Yeah, Forex Gal's talking about lumber, and I used to watch it and trade it, and it's like at 700-800, they can't get lumber to build houses.
Again, think about it. It's the supply.
Chain.
That's
Yeah.
right. It's a supply restriction.
Yeah.
And what do we get? We get massive price increases and inflation. Corn, same chart, 6-year base.
Yeah. Some great opportunities setting up.
You want some coffee in the
stuff.
morning? How about this?
Yeah.
Coffee broke out of a 9-year downtrend line,
Yeah.
sitting on top, huge base, ready to
Yeah.
go. If you have coffee, you got to have some sugar.
Yeah.
Same pattern. How about some
Look where
cotton?
sugar went to.
Yep.
Yeah.
How about cotton? Want some cotton for your clothes?
Yeah.
Look at that.
Yeah.
Same pattern. And it's not unrealistic to look for moves like this coming out of a base like that.
Yeah.
And so that's multiple commodities. We've seen it. Crude, people are interested in crude. Now, crude doesn't base. As you know, crude is so volatile, it spikes. But I wouldn't be, there's a similar pattern here, right? Are we going to get some sort of crazy supply dislocation in crude and a spike in crude? It's possible. It doesn't have.
I actually think crude is going to be part of the stag rather than the inflation, at least for a while longer.
And you know what, Dale? I think that's a good possibility because if you think about how crude has reacted, it's been the inverse in this
Right.
cycle from the 70s. So that may happen.
So we went from minus 38.
Yeah.
I mean, do you measure your fibs from minus 38 to 44? I don't know. I
Yeah,
do it
it's-
from, anyway, yeah, I think this is going to be part of the stag.
Yep. And so the last thing I want to do is, because I know there's a lot of currency people out there, is we're going to start posting some currency stuff for people, trade patterns that get initiated by our system. These little circles
Yeah.
show when they get initiated. If there's multiple circles, it's because there's a continuation trade. And the main thing about this pattern system is it shows the beginning of a fast trend. The trend could be weeks, could be months, because we're doing this on a daily basis. The main thing is it's not a corner seeking pattern. You're not trying to pick tops and bottoms. You're trying to find the trend when the trends kick in, and it keeps you out of chop. So I'm just going to give you 3 quick examples and then we'll be done. This is for the Aussie JPY, first triggered here. Then we had a continuation here. Next one is the Euro, triggered here, continuation here. And you can see they're affected on these pullbacks, right? They get set up, and then you enter when you get these kind of pullbacks, and the trends line up and the signals generated.
Nice.
And then there's one for the pound yen.
Okay.
And that's it.
Ben, thank you so much for putting all this effort into this presentation. Everyone thank Ben for putting energy into it. A lot of people come on, they just wing it. And, the sign of somebody who is effective in life is someone who prepares. And that's always been a problem for me. Anyway, listen, Ben, my trading warrior brother, a lot of people really loved it. What's the best way for them to stay in touch with you, follow you?
Yeah, I've got the Twitter handle up there. If they want to follow me, I post everything there. I try to be responsive. DMs are open, and just trying to hold myself accountable for what I say by putting it out there and helping people if I can.
Really a pleasure, buddy. And I hope you and your loved ones remain untouched and that pips rain down on you this fall season. And I'll get a hold of you a little later in the day. We'll get you on the books for after the election and see what America looks like in November.
Sounds
What do you
great, buddy.
think?
I think
right,
that
so-
sounds fantastic.
All right, Ben, thank you very much. You really are my trading warrior brother and a friend. Pretty cool. And I want to thank everyone for their attention. This one's worth watching again, in my extremely accurate and humble opinion. So everyone remember, don't just count your pips or your grain or your coins or your shares, count your blessings, and we'll see everyone on Monday. Enjoy your weekend. Adios, everyone. Thanks again, Ben.
Thanks, Dale. Take care.